Thank you very much for joining us, Fotios.
Thank you very
much.
What
Fotios does is basically act as, just tell me if this is correct.
Sure.
You act as kind of a consultant for many of the world's biggest investors, including wealth managers, but also fund managers and I think institutions as well. So kind of across the board, essentially, how do you actually implement, a little like Dan Kemp, who is there, who also does a kind of similar thing. How do you actually implement some of these ESG requirements that you might have into an actual portfolio? So we've been talking this morning, people very eloquently talking about the issues themselves, how it affects the actual companies. But what matters is, to most of the people in this room, is, so what do you do about it? What do you do with the portfolio? What do you actually do? How does it impact how you should invest? So what I'm going to ask Fotios to do, for all of us, is basically go through what some of his clients have been doing, how they've been impacted, especially by some of the big we talked about this earlier on, like what are the big issues that have happened recently, who's been successful in changing their portfolio to deal with some of the big issues, who's not been successful. You don't have to name them, but please tell us the mistakes they've made, and we're going to get that kind of discussion going. And I'm not going to pick the long-term issues, because they've been well discussed already today, though I'll do that later, but actually some of the more short-term issues. What are we now dealing with in terms of like current crises? So there are 4 big issues that I'm going to cover, just so you know, so it's all up front. First of all is the war in Ukraine, clearly. Like, what have people actually done in terms of reacting to that? And we've done a load of research at ESG Clarity on wealth managers' responses to that. One, obviously, is the threatened spike in inflation, rise in interest rates, which is a massive ongoing problem, but it's really become obvious. The ongoing climate threat, clearly, and then obviously the stock market changes recently, which seem to have not necessarily favoured the traditionally high-scoring ESG stocks. So, with all that out the way, let's talk with the war in Ukraine. What have people been doing? What's been successful? What can we learn?
No pressure.
No
Easy
pressure
topic.
at all. Yeah.
Clearly, the vast majority of clients have been asked to basically meet the primary objective, right, which is, at the very least, protecting the client's wealth, while at the same time acting in a more responsible manner towards allocating capital towards more sustainable investments. Now, given the circumstances, the geopolitical events, the war in Ukraine, and so on and so forth, this is a very, very, very hard balance to strike. Right? There's no doubt about that, and I'm pretty sure that everybody's well aware. So I have to admit that the vast majority of clients have been holding quite firm in their position, going back to the drawing board, trying to understand what they own, what are the explicit and the implicit dependencies, because the reality is that many of the points that you've mentioned inflation, you've mentioned the energy crisis, you've mentioned central bank policy, if I'm not mistaken, and so on and so forth. They're all interlinked with ESG and or climate dimensions, right? And that's a reality, and we'll get into that in just a second. So I would dare to say that the vast majority of clients have been, I think they've been acting very, very responsibly on both fronts, right? And of course we had, the very few that have been probably, the term is overwhelmed by what's been happening. So, we've heard them saying, or calling ESG a fad, a bubble that was it was just a matter of time to burst, right? There was a lot of liquidity out there, so there you go, MSCI. Of course, I believe it was mentioned during the introductory points, the money continued coming into those type of strategies, right, since COVID hit in. Right, and that's something that some of the clients did not realize. So the second category is those that have been affected quite a lot. Right, they have this kind of short-termism, if I'm allowed to use a term, and they've been affected a lot by social media, the press, the noise, right, and they didn't stick to the fundamentals. Right? And I'm stating the obvious now, right? Stick to the fundamentals, think long term. And the third, which to me is by far the most important aspect to consider, is that some of the clients came to the sudden realization that ESG and climate is investment risk. And I know that the vast majority of people in this crowd, right, are very, very familiar, but I can give you very, very tangible examples rather than just make generic statements. So some of the work that we've done about the war in Ukraine basically further justified how this information, right? So the carbon emissions, the S pillar, the E pillar, the G pillar, right, can be fully integrated into the investment decision process, right? So one example. So if you have a look at the emerging market block, right, from an equity point of view, Hungary has been the country, right, thinking about index terms, right? So the country index has been the most impacted emerging market country since the war started.
Hungary has?
Hungary.
Okay, go on.
Yeah?
Explain why that is.
So it's very, very interesting because, yes, if you have a look at the stream of revenues of companies, there's a strong linkage to both Ukraine and, unfortunately, Russia. So some might say, well, yes, that's quite straightforward. But it gets even more interesting because once you slice and dice this information, you come to realize that the biggest ones, I don't want to be using any names, by the way, I'm more than happy to follow up for apparent reasons, so I don't want to be pointing the fingers to
there's only cameras running, it's fine. Name away.
Exactly. So some of the biggest banks, in fact, the biggest bank of Hungary, not only has been operating in both Russia and Ukraine, but we had a look at their book of business, right, their loans. They've been financing the energy sector. So we had a look at their basically scope 3, implicit, right, dependencies, implicit emissions, right, and suddenly everything made sense because this part of their book turned red. So rather than, ticking the box and saying, well, okay, that is a bad company, because of their carbon intensity or, making sure that we send the reports to our investors or clients, if you like, suddenly, right, you could capture that that beta, if you like, right, and use that as part of your investment decision process. So it's a very, very different perspective, right? And I know that a couple of the speakers have implicitly mentioned that, but it's actually very, very interesting to see that it's very, very tangible, it's measurable, right, and it's out there. So
can I just get into some specifics of this? Okay, so let's just talk about again the energy crisis, which has been created partially by the invasion of Ukraine. You've got two things happening simultaneously. One of them is you go, well, in that case you should rely less on oil and gas because that's specifically what Russia creates. Okay. The second though is that you should just be isolationist, because we don't want to rely on anyone else. That's the social impact, right? If we rely on anyone else, then potentially, if you have a bad actor in the global community, then potentially you're going to be, blackmailed by them, if you like, to stay quiet because they're providing you with what you need. So how has that, how your end clients kind of tried to balance those two things, and to throw in an unfair extra thing, which is nuclear. Because again, this
I thought you would have never asked.
I mean, it's just it's an ongoing problem. I know Jonathan Porritt talked about it. It's a big problem constantly, which is the fact that nuclear it doesn't cause. It's a fantastic solution to our world energy problems until it's a massive problem. It's like buying insurance, and eventually it goes wrong. So tell me how all that's been balanced.
So the reality is that if you go back to the drawing board, you need to take into account the following: that ESG and climate are there to complement the investment decision process, right? It's not the full picture. And again, I'm going to be quoting some of our previous speakers, right? So you have the fundamental analysis. You need to understand, the business model, how their book of business looks like, and so on and so forth, leverage, and so on and so forth. And then on top of that, right, complement your analysis with these dimensions. That's one thing. So the question is, well, given what's been happening, right? Oil, if you have a look at the US oil sector, is going up by, I believe, close to 60% year to date now. Is there any room to hide? And the answer is yes, of course. We've been very, very lucky, over the last 3 years or so, we have a lot of building blocks to implement, right? With an ESG overlay, with a climate overlay, whether that's basically, more, climate-oriented sector solutions, factors, even on a country level, right, and so on and so forth. I'm not going to give anybody, an investment advisor. We're not in the business of doing that. But the reality is that, you can basically express your investment views and meet your investment objectives while taking into account all these additional considerations. Yes.
Okay, let's move on to other areas. Again, as explicitly as possible, like I want to know what your underlying clients have done and how they've changed what they've invested in. So the other one, of course, is suddenly inflation seems to have come.
Yep.
And interest rates are going to start rising, and we are, obviously, the terrible threat of stagflation kind of appears amongst us. And it's the one thing everyone's been waiting for 10, 15 years, and it hasn't yet happened. So first of all, your clients, and when you're discussing with them, has anyone done anything? Are they able to substantially reposition themselves? And in the long term, what do we do about bonds?
Well, no pressure again, right?
Yeah.
Okay. So I think we need to go back to the drawing board and think about, those macro forces, right? There's been a lot of talk about the war in Ukraine, right? Inflation, the Fed. But the reality is that inflation has been driven by one thing, and many of the very, very serious economists out there, certainly I'm not one of them, have been writing about this for over a decade: excess liquidity. Now, everything else, the war in Ukraine, of course, one of the speakers mentioned earlier on about employment, right? Of course, that plays a role. The energy crisis, the war in Ukraine, further reinforce, right? Further push inflation higher. So what investors have been doing is try to basically understand the macro landscape and allocate capital accordingly. Now, let me be a bit more specific, and I haven't answered basic part of your previous
exactly.
question about
Which way have they gone?
for nuclear, and we'll get into that.
Yeah.
So if you think about, which industries have been benefiting the most, right? Of course, energy is one of them, but also materials. In Europe, you had telecommunication services, right, which has basically anything that is more linked to the real economy, but also if you move away from the developed world, you can see in certain countries industries such as utilities and or consumer staples, because of the price inelasticity, have been benefiting quite a lot, or at least on a relative basis. So there are ways, there are spots, or there are opportunities out there. But again, you don't have to sacrifice, right, your climate and or ESG objectives, right, to meet your financial objectives. There are there's a lot of different ways through, using third-party active managers, passive, although I don't like the term, if you like index, types of solutions. Now there's the ability to customize, right, literally within days, and express your investment views, right? There's a number of different providers. It's not about, this is not a sales pitch. It's just, how the industry has been evolving. So there are a lot of, different ways. And let's not forget the obvious ones, right? So you have the big commodity producers, right, on a country level, right? I'm not going to mention who they are. Think about the AAAs, right, within the developed world. There are not that many out there, and so on and so forth. So we've seen quite a lot of money moving towards, these. So the linkage between macro, right, and what you would traditionally do with a very, very, strong consideration around ESG and climate is basically the solution. So there's no magic recipe.
But
right?
do you think there is so the issue specifically with like inflation and interest rates coming? What is there even an ESG issue there in terms of buying more inflation protected kind of?
There's not an issue. We need to take into account, right, the very nature of those companies, right? If you assume that you have companies with strong ESG credentials tend to focus, and this is probably a bad generalization, right? But if I have to give you an answer, I would go down as follows. So companies with high ESG credentials tend to have a more tech-oriented type of approach, because they do develop a lot of patents, solutions, provide services, and so on and so forth. So they tend to have, and I'm choosing words very carefully here, less tangible assets. So of course, right, when you have, the central banks and especially the Fed rising rates, they tend to basically impact companies that trade on higher multiples. So by definition, many of those companies, right, are more expensive. So we've seen a lot of that happening, but it has nothing to do with the ESG, credentials per se. It's just the very nature of the companies themselves. The best way to put it is, if you think about companies that operate in the same industry, they have, they produce the same products and or services that are about the same size, they operate in the same geographical area, and the one has strong ESG credentials and the other one has poor ESG credentials, which one would you go for? It's basically a premium, right? And the reality is that, it's all about the longevity of those companies, right? The notion of sustainability is not only about society, but it's also about companies being around in the next, few decades. So there is that linkage there, right? But it's not a one-to-one type of relationship.
In fact, is there I wonder if is there an arbitrage? I mean, sorry, this is now thinking like a nasty hedge fund manager who wants to quickly see, is there anything clever here? But is there an arbitrage with companies that actually have got good ESG credentials but are not being rated that way? And in fact, eventually they're going to get, I mean, is there literally a way you could try to make money through that?
I will try to avoid answering that question for apparent reasons.
Yeah, go on.
But if you don't mind, I would like to address the audience a little bit and ask if anybody's willing to share their views about how they've been allocating capital, if you don't mind me, during this very, very volatile period.
So what do you want to ask them? Well, if anyone's going to talk about if they've been changing their capital allocation. Is anyone happy to share? Put up your hand if you are, and we'll get a microphone to you. Just like if you've got an experience where you've actually specifically, I guess, in the last 6 months, a year, gone, you know what, we had to, substantially change what we're doing. If anyone is happy to, it's a little tricksy to do in public like this, but if anyone is happy to share, please.
High level.
High level? Anyone? You're going to keep it to yourselves? Yeah, gentleman in the middle there. Yeah, do you want to shout? Have we got a microphone anywhere? If not, I'm sure you can shout out to the small room. Yeah, go on, just shout it out and I'll repeat it, and then everyone can hear.
I think that what we've worked out is there was nowhere to hide. So, particularly at the lower risk end of the spectrum, where bond managers have really given up trying to manage duration and have really not tried to manage risk through this. And pitting that against the equity side of things, where the long-term story is still probably good. So, in the basis of wants to stick to the knitting. If your portfolios are in good shape going into a crisis, they'll probably be in good shape coming out.
Mm-hmm.
But if we're investing in funds, we're relying on the managers to navigate this.
Did you move away from like the big bonds? Have you reduced your like government bond exposure to try because they are struggling to make any kind of alpha?
We just had to take duration away from the managers that won't.
Yeah. So you need more active managers on the bond side, basically.
They need to play the game.
Yeah. There you go. All right. Fantastic. Yeah. There you go. Any response? Is that something that you would advise if you were advising this gentleman here?
I'm not going to advise.
Not allowed to.
anyone. But this is some of the things that we've seen happening, right? I've mentioned rotation within sectors. Certainly going down reducing the duration of the portfolio, but also the credit risk component, right? Because if you think about high yield strategies, I'm just going to be steady obvious, right? There's a lot of dependency to the oil sector, especially in the US. Mm-hmm. But the reality is that I would only disagree with the statement that there has been a place to hide. There has been a place to hide, but you have to be going back to the fundamentals and combine both ESG and climate credentials along with the macro forces.
And also, is there a truth just to the general notion? Because we all say this as if it's true, but I've not seen numbers that say explicitly that if you care about ESG and you factor that in, that you're more likely to do well in the longer term as opposed to the shorter term. Because in principle, you could be damaged in the shorter term if you have companies that are damaging the environment. Mm-hmm. But everyone talks about it as if in the long term somehow it's going to be magically those companies will be. Rewarded.
There was a fantastic paper by one of our senior ESG index researchers. It was about the fundamental principles of ESG, and what we found out was that there's a strong linkage between companies with high ESG credentials and higher return on equity. But
is that just the governance? Is that just because they care about shareholder value, or is that also explicitly the E and the S side as well?
No, I'm talking about the corporates now, mm-hmm. Right? But the important aspect is to bear in mind that you need to compare like for like. Going back to the previous argument, right? Companies that have the same size, same profile, right? So they tend to have higher return on an equity. And the reason is very, very simple, right? I think it was mentioned multiple times. So you have a company that basically wants to attract new talent. They have the ability, going back to the S-pillar discussion, right, to retain talent. They're willing to invest in their stuff. They have better governance, right? They know, what's on their book. What's not to like? And the reality is that this is the investment element that I was referring to, right? So all this information, right, is being reflected into, at least in the longer term, in higher ROE. And don't take me wrong, companies with higher ESG credentials, of course, they're facing a lot of risks, right? And we've seen, many of them involved in many controversies. The major difference is that they tend to act fast to tackle those problems.
Okay. Mm-hmm.
Right, so this is one thing that we MSCI takes into account very, very seriously, and that is how basically they mitigate those risks, right? Because there's no such a thing as a perfect company. We don't live in a perfect world. Things will go wrong. So that's another dimension that we do take into account.
All right, we've got about a minute left. Chris, first of all, quickly tackle nuclear. I know most of the time you can't really get access to, because nuclear, it's always governments that back these things anyway, so you can't really often get exposure. But has anyone done anything in terms of exposure to nuclear or moving away or towards it? Or does everyone just avoid all energy sectors anyway?
Yes, I mean, of course, there's a big debate, right? We've seen some of the biggest economies, especially in Europe, right, suddenly changing their energy policy overnight, which in turn implies that many of the biggest investors out there pick up the phone and call us about what that would mean about the shape of existing indices, because of course on the one hand you have the so-called business involvement dimension, right, in many of the MSCI indices in the overall framework, which implies that you don't want to get too much exposure into nuclear because ultimately a lot of the risks cannot be hedged out. Right? If things go wrong, unfortunately, we've been there quite a few times in the past. But at the same time, when you have Germany, the UK having a change of heart, what do you do from here? And the answer is that remains to be seen. Unfortunately, I don't have an answer for that. I wish I had. But the reality is that we run a number of different consultations. We ask clients about their views, but we live in interesting times. So
yes, we certainly do. Yeah, exactly. Right.
That's as honest as I can be.
No, thank you very much for that. We are out of time. That was very quick. There's a lot more to talk about. Fotios Kassianidis is going to be here. Are you going to be here for the rest of the day?
Yes.
Great. Grab him, because as you can tell, there's a lot of expertise and experience there, which we're going to cover. In the meantime, thank you very much to Fotios. Thank you.